Let me share a number with you that almost nobody outside the precious metals world is paying attention to. 13.4%. That is the current COMEX silver coverage ratio. And if you have never heard that term before, stick with me, because once you understand what it means, you're going to see the silver market very differently than you did 3 minutes ago. Here's what it actually says. For every single ounce of silver physically sitting in COMEX warehouses that can be immediately delivered right now, there are approximately 7.5 paper contracts out there claiming ownership of that same ounce. 7.5 promises for every one piece of real metal. The math does not work if everybody suddenly asks for what they're owed. And here's the part that should get your attention. This is not a theory. This is not a gold bug conspiracy. This is data published by Citigroup itself, every single trading day. Anyone can look it up. By the end of this video, you are going to understand exactly what the COMEX coverage ratio is, why 13.4% is considered stress territory, what actually happened in January 2026 when silver briefly went to $121 per ounce, why the market still has not structurally healed from that event, and what all of this could mean for the price of silver over the next 12 to 24 months. This is not a panic video. This is a data video. Let's get into it. First, we need to understand what COMEX actually is because this is where a lot of the confusion starts. COMEX, short for commodity exchange, is the primary futures market in the United States where silver and gold are traded. When somebody buys or sells a silver futures contract, they are essentially trading a promise that on some future date, a specific amount of silver will change hands. Each standard COMEX silver contract represents 5,000 troy ounces of silver. That is a lot of metal. Now here's the key thing most people don't realize. The vast majority of those contracts, historically somewhere around 97% to 99%, never actually result in physical silver being delivered. Most traders buy contracts to speculate on the price, then close the position or roll it into the next month. The system functions because almost nobody actually asks for the silver. But some people do. And that's where the physical side of the market matters. COMEX-approved warehouses hold 2 categories of silver. There's registered inventory. This is silver that has an attached warrant, meaning it is specifically allocated and immediately available for delivery against futures contracts. Then there's eligible inventory. Silver that meets the quality standard but doesn't have a current warrant. That silver belongs to someone who has chosen not to make it available for delivery. The coverage ratio, the number I opened this video with, is calculated by taking the registered inventory and dividing it by the total open interest in silver futures, measured in ounces. As of late March and early April 2026, registered silver inventory stood at approximately 76.88 million ounces. Open interest, according to BloFin research and Citigroup data, stood at approximately 575.5 million ounces. Divide those and you get 13.4%. That is the 6th consecutive reporting period where the ratio has sat below 15%. Now, why does 15% matter? Because 15% is the threshold that COMEX analysts themselves identify as stress territory. Below that line, historically, delivery squeezes have become significantly more likely. And we are solidly below that line. We have been for months. Let me walk you through exactly what happened in January 2026, because this is where the theoretical stress became real. Very fast. In a single week in early January, 33.45 million ounces of silver were physically withdrawn from COMEX registered inventory. That's roughly 26% of the entire deliverable pool disappearing in 7 days. In a normal month, COMEX typically sees between 10 to 20 million ounces delivered in total. 1 week in January pulled out more than that. Delivery demand during that month spiked toward 5 to 10% of contracts, compared to a historical norm of less than 1%. That might not sound like a lot, but when you're applying it to a system with over 500 million ounces of open interest, the physical strain is enormous. Silver's price responded the way you'd expect. It ran from the mid-70s in late December up to an all-time high of $121.64 per ounce on January 29, 2026. Year-to-date, silver was up roughly 135% before the correction hit. During that rally, the gold-silver ratio compressed from over 100 down to around 64, meaning silver was massively outperforming gold as investors and institutions scrambled for the physical metal. Then on January 31st, the rug pulled. Silver fell 31% in a single day. Gold dropped 12%. The ProShares Ultra Silver ETF lost more than 62% in one session, its worst day ever. This was the largest single-day decline in precious metals since 1980. What caused it? A combination of things. President Trump nominated Kevin Warsh as the next Fed chair, a more hawkish pick than markets had been positioning for. CME Group simultaneously raised margin requirements on silver futures, forcing leveraged traders to post more collateral or liquidate. And the timing was brutal. January 31st was the final trading day of the month, with February 1st falling on a Saturday, which meant futures markets would not reopen until Sunday evening. Every position had to be adjusted on that one Friday. It was a forced unwind. Here's where most commentary stops. But the real story is what happened next. Or more accurately, what didn't happen. Silver fell from $121 down to the mid-60s over the following 6 weeks. A 40% plus correction. In any normal commodity market, that kind of price drop would coincide with registered inventory refilling. Lower prices should attract silver back into the deliverable pool as holders reassess whether storing metal for delivery is worth it. That's not what happened. According to the CME Group's Daily Metal Stocks report from April 13, 2026, registered silver inventory held essentially flat through the entire correction. Silver traded in a 6.6% range between April 7th and April 13th, swinging from $72.26 to $77, then back down. Registered inventory moved by just 40,000 ounces in that window, essentially zero. That is the signal. When registered inventory does not respond to significant price movement, it tells you something very specific about who is holding that metal. They did not release supply at $77. They did not pull it at $73. Whoever owns that registered silver is not a short-term trader. They are long-term institutional holders who are not selling at these prices. And here's the most striking data point. As of April 2026, the paper-to-physical leverage ratio sits at approximately 7.5 to 1. For every ounce of immediately deliverable silver in COMEX warehouses, there are 7.5 ounces of outstanding paper claims. In a normal COMEX operating environment, this ratio sits between 5 and 8 to 1, so by itself it's not unusual. The system works because almost nobody asks for delivery. But combine that leverage with the 13.4% coverage ratio, and you're looking at a market that is one significant delivery event away from a genuine supply crisis. Now here's the part that makes this a structural problem, not just a COMEX problem. Silver isn't just a monetary metal anymore. It's an industrial necessity. The Silver Institute has now projected a 6th consecutive annual supply deficit for 2026, estimated at 46.3 million ounces, up from 40.3 million ounces in 2025. Since 2021, above-ground silver stocks have been drawn down by approximately 762 million ounces to cover these annual shortfalls. That's nearly a full year of global mine production gone. Why is demand so persistent? 3 main drivers. First, solar photovoltaic panels. Solar alone is projected to consume between 120 and 151 million ounces of silver in 2026. Each silver panel contains 15 to 25 grams of silver paste. And while some manufacturers like Longi, Jinko, and Ico Solar are actively working on copper-based replacements, most of their mass production timelines stretch into 2027 and beyond. Solar demand is expected to ease slightly in 2026 but remain near record levels. Second, AI data centers and electronics. This is where the silver story has genuinely changed in the last 18 months. The rapid build-out of AI infrastructure, especially data centers in the US and China, is consuming silver at scale. Silver-plated copper connectors, semiconductors, high-speed transmission hardware, and power delivery systems all require silver for its unmatched electrical and thermal conductivity. Seeking Alpha's January 2026 analysis estimated that data center silver demand in the US and China combined reached approximately 350 million ounces in 2025. Exceeding 50% of total global mine supply. Third, electric vehicles, grid infrastructure, and consumer electronics. EV production at 14 to 15 million units this year is expected to contribute another 70 to 75 million ounces of demand. Grid upgrades and transmission hardware add another 15 to 20 million ounces. And on the supply side, it's stuck. Over 70% of silver is produced as a byproduct of copper, zinc, and lead mining. That means silver production responds to base metal economics, not silver prices. You cannot just dig more silver out of the ground because the price went up. Recycling growth is limited by refinery bottlenecks, and China, the world's largest silver producer and processor, implemented a new export control regime on January 1, 2026, reclassifying silver as a strategic resource and restricting outbound flows to the West. So let's put all of this together. You have a COMEX coverage ratio at 13.4%, sixth consecutive reporting period in stress territory. You have 7.5 paper claims per ounce of deliverable metal. You have registered inventory that refused to rebuild through a 40% price correction. You have a sixth consecutive year of structural supply deficit. You have industrial demand driven by AI infrastructure and renewable energy that cannot easily substitute away from silver. You have the world's largest producer restricting exports. And you have Shanghai physical silver trading at a persistent 12 to 13% premium over COMEX paper prices. What does this all mean for prices? The range of forecasts coming out of major institutions is unusually wide, which tells you the market itself is uncertain about how this resolves. On the conservative end, the Reuters poll of analysts now projects an average silver price of $79.50 per ounce for 2026, up from $50 back in October 2025. JPMorgan's 2026 target is $81 per ounce average. More bullish forecasts. Bank of America's Michael Widmer has a 2026 range of $135 to $309 per ounce, based on historical gold-silver ratio compression scenarios. Citigroup set a $150 to $170 target in late January. Macro strategist David Hunter projects $180. And then there's the extreme end. Robert Kiyosaki at $200. Tom Bradshaw targeting $375 by 2028. I'm not telling you any of these forecasts are right. Forecasts are opinions. What I am telling you is that when Bank of America, Citigroup, and Reuters are all raising their base case silver targets significantly in a 6-month window, something structural is being recognized by people whose job is to be right about this. The bear case is also real. If the Federal Reserve stays hawkish, the US dollar strengthens, industrial demand softens beyond expectations, or the physical crunch resolves through quiet coordinated inventory releases, silver could revisit $54 or lower. Technical analysts are watching $63 as a critical support level. If that breaks, the bear case becomes $54 to $50. Both cases are on the table. The reality is probably somewhere in between. But the coverage ratio tells us that the market structure is tilted more toward upside resolution than downside breakdown, because the physical supply cushion that would normally absorb a demand shock simply isn't there anymore. So what's the practical takeaway here? First, do not panic. Markets don't break overnight most of the time. The COMEX system has survived stress periods before. Exchange operators have tools, increased margin requirements, delivery deferrals, cash settlements under force majeure, that can absorb enormous pressure. A coverage ratio below 15% does not automatically mean the market fails. It means the system is operating closer to the edge than usual. Second, understand what you own. If you own silver through a paper product like SLV or a silver futures ETF, you own a financial claim backed by paper contracts, not physical metal you can hold. In normal times, that's fine. In a structural squeeze, it may not be. The distinction between paper silver and physical silver matters more now than it has in decades. Third, do not chase. Silver has had extraordinary volatility. It went from $29 in April 2025 to $121 in January 2026, then crashed 40%. That is not a normal asset class. That is speculative volatility on top of a structural story. If you're thinking about adding silver exposure, think about it the way institutional investors are, as a long-term portfolio position at a modest percentage, not a concentrated bet. Fourth, watch the coverage ratio. It's public data. It updates daily. If it drops below 10%, or if we see another January-style single-week inventory withdrawal, that is your signal that the physical market is under genuine stress. And pay attention to the Shanghai premium. When physical silver in Asia trades persistently above paper silver in New York, you're watching price discovery shift away from the West. Let me wrap this up. A 13.4% COMEX coverage ratio is the single most important number in the silver market right now. It tells you the physical supply backing the enormous paper derivatives market has been drawn down to historical stress levels and has not recovered despite a 40% price correction. Combined with a sixth consecutive annual supply deficit, unprecedented industrial demand from AI and renewable energy, and Chinese export restrictions, The structural setup is genuinely unlike anything the silver market has experienced in decades. That doesn't mean silver goes straight to $300, but it does mean the old assumption that paper silver prices always anchor physical reality is being tested in real time. If you take nothing else from this video, take this. The data is the data. You don't have to take my word for it. You don't have to take any YouTuber's word for it. The CME Group publishes these numbers daily. The Silver Institute publishes their annual surveys. Bank of America and JPMorgan publish their forecasts. Anyone can verify every number I just gave you. One final reminder. This video is educational. I am not a licensed financial advisor. Before making any decisions about silver or any other commodity, please speak with a qualified financial professional about your specific situation. Commodities are volatile. Leverage is dangerous. Only invest what you can afford to lose. If this helped you understand the silver market better than the usual doom and gloom or moonboy content you see on YouTube, hit that like button. Subscribe if you want the next video. A deep dive on Shanghai premiums, physical versus paper silver, and whether SLV actually owns the silver it claims to. Coming up next. See you in the next one.